Dang mute button. Okay, so good morning. Welcome back. If you were here for the last installment of this webinar, I'm Ebony Russell, and I'm going to go ahead and share my screen now so we can get started. So it's good to be with you all today. Last time we talked about client eligibility criteria like lawful presence, housing counseling, income limits, types of income, that kind of thing. This time, I thought that we would do a few exercises to help us to explore some of the scenarios that determine those outcomes. And we'll also discuss loan approval policies and procedures for all programs and discuss policies specific to DPEA and SBU programs. So just a quick recap of common sources of income. There are most clients will report one or more of these sources of income. So for wages, you want to get 2 months of pay stubs or third-party verification if those cannot be obtained. Social Security, you'll want, if they claim Social Security, you'll want to get an award letter. For other types of benefits like retirement benefits or VA benefits, an award letter is acceptable or third-party verification is acceptable. Child support is a little more involved. So if an applicant is reporting money received, then you want to get either a court order or the Family Support Registry printout. If either of those are not obtainable, a signed, dated letter from the parent providing the support stating the amount and frequency of payments is acceptable. So if the applicant is reporting no money received, but they are a single parent with custody, 50%, then you want to get either a letter stating why the money isn't received from the absent parent or a FSR printout, regardless of whether income is being reported or not, because this Family Support Registry printout will document that no money is being received through their agency. You can call the number at the bottom. All agencies in Colorado can call this number. The applicant would need to be present and request that a printout be sent to your office via email or fax, whichever is best for you. Applicants usually claim an asset, checking or savings. And for those of you who want to get 6 months of bank statements or a third-party verification, all checking and savings account calculations must consider the 6-month average and not the current balance. And so be sure that you are getting that 6-month average for savings and checkings accounts. I mentioned this in the last webinar, but I thought it was worth mentioning again that this is a good tool to use for determining what documentation to use. And if that documentation isn't available, it points you to the next best acceptable information. So this is the HUD 4155 doc is a good source for determining how to use third-party verification. So this is our first scenario, and just be aware I'm going to ask some questions, and I'm hoping for a little participation on your part. So the first scenario is for Patricia, who is a single mother with one granddaughter, and she's applying for down payment assistance in Alamosa, which is an HDG funded program. She has reported the following documentation, and she's provided support for it. So she has retirement benefits, child support income, checking account, and savings account and assets. So the retirement income she receives is $1,750 each month, and she receives $650 in child support each month. She has a 6-month average balance of $5,000 with an interest of 7%. And she has a checking account with $4,000 in it. So remembering that she has provided a snapshot of her income that we'll need to annualize to predict her income for the year. So we'll take all of that income that she provided and annualize it for 12 months. So she's receiving $1,750 each month. That's $21,000 a year. $650 in child support. That's $7,800 a year. And she has a savings account. The annual passbook rate is 6% this year, but her checking or her savings account yields 7%, so we have to use the higher. We'll multiply that by 7% to give her $35 in income from that $5,000 each year, giving her a total income of $28,835. So we'll need to determine her income limits. So we will do that by looking at the rent and income limits from CHAFA, because this is an HDG funded program. CDBG funded and HDG funded RLF programs use the CHAFA income limits, while home funded programs use the home income limits. And there's going to be a little trouble with transitioning. When I exit from the screen, I'll have to come back and tab to the place that I was before. So just be aware of that. So looking at the income for Alamosa, knowing that her income is $28,500 for the year, it looks like she has 50% income in Alamosa for a 2-person family. So my question for you is, based on her income, does Patricia qualify for the HDG funded program, for the HD funded DPA program? Does anybody want to give me a yes or a no on that? No takers? The answer is...
Put your answer in there.
I'm sorry, go ahead, Ariel. You can put your answer in, yeah. So the answer is that she does qualify. Thank you, Jennifer. Yes, she does qualify based on her income. The minimum income for the DPA program is 50%. And so she would qualify for that program. Another question I would ask is, are there any additional steps that should be taken for her participation? Is there anything else we can do knowing that she qualifies at 50%? Additional counseling. Pamela, if I had a prize, I'd give it to you. Yes, she would require additional counseling because her income is at the minimum of 50% that we can accept. And with 50% income, that requires additional counseling and additional budgeting support throughout the affordability period. So moving on to the next example, which would be Titus. He has a family of 4, and he's applying for the single family owner-occupied rehabilitation program in Colorado Springs. The environmental review states that Titus lives in a floodplain area, and according to his income asset questionnaire, he has provided proof of employment at $22 an hour, a checking account at $1,800, and a savings account at $10,000 with 6% interest. His employment remember he said he's $22 an hour full time. So that's 40 hours a week. We're taking that snapshot and annualizing it. So that would be $880 a week times 52 weeks a year, which is $45,760. I have a question and I can't see the chats right now. Let me just get back to that. The question is, if he was paid biannually or twice a month, would there be a difference in his income? No. Jennifer says no. And for, I think that there would be, and I'll just show you here. For income, if he is reporting $880 every week, and we can annualize that at $45,760 a year, if he was paid twice a month, we would have to take that income, 880 times 2, because that's 2 weeks. Twice a month, he's paid 24 times a year instead of 26 times a year. We would multiply it by 24, which would yield a difference in income of about $3,000. And so that would mean that his income would be a little lower and possibly change his determination for eligibility. So you want to be careful when looking at the frequency of pay for income. So if he's paid twice a month, that's different from being paid every 2 weeks. Every 2 weeks is 26 times a year, which would give you that $45,760. But if he's paid twice a month, he'd only get $42,000 a year. And so careful with that when analyzing income. He has a savings account of $10,000 at the annual passbook rate, which gives him an income of $60. And that takes you to the total of $45,820 a year. So going back to our CHAPA website, because this is a CDBG funded program, which will also use the CHAPA income limits, making sure that we are looking in the right county, which is El Paso for Colorado Springs, knowing that his income is about that $45,000 a year for a family of 4. That means that he's at 55% for income there between those 55 and 60. So my question would be, does Titus qualify for the single family owner occupied rehab program? Going once, going twice. The answer is yes, he does, because there's no minimum for the single family owner occupied program. No, there's the 50%, but then he qualifies there, but the maximum is 80% income for that program. So he does qualify. And an additional question would be, are there any additional steps that should be taken for his participation? And I'll give you a hint, it was mentioned in the environmental review. Going once, going twice. Flood, yes, the floodplain. Yes, very good. Those are some great answers, everybody. Yes, he needs proof of flood insurance because he's in a floodplain area. So I know that your programs are just going to be run excellently. So that was the question. And based on this scenario, what other documentation would you gather? So what other documentation is necessary for single family owner occupied programs when they are needing to prove that they own the home? Title commitment. That's a good answer. ID, yes. And one more, if they don't have any of that, would be any documentation from a federally funded agency like the Social Security Administration, something like that with their address on it. So that's a big drop down for you. So I'm going to go back into full screen. It's going to take me a minute to get to where we were. So just give me a second for that. So now we're going to move ahead and start talking about loan approval, denial, policy, and procedure. So we're going to discuss the minimum loan amount, the maximum loan amount, the minimum homebuyer equity contribution, HUD affordability period, loan terms, underwriting criteria, responsible lending standards, additional lending guidelines, and loan fees. So we know that the minimum loan amount for all RLF programs is $1,000, and this is based on home regulation. DOH also applies this policy to CDBG and home HDG funded programs. We use Part 5 annual gross, or the Part 5 income calculation to determine annual gross income. And we also use that to determine front and back end ratios. So the overall debt generally should not exceed 43% of gross income for any household. Agencies may exceed that on a case-by-case basis, going high as 55% of gross income. Agencies are also allowed to develop an alternative method of calculating income for the purposes of underwriting, but this method should be underlined in the program's guidelines and approved by DOH. The amount of assistance in loan terms must make the home purchase or rehabilitation affordable to the client without over-subsidizing them. And so when taking in their income, you must also take into account their monthly bills, their available assets, evaluation of their first mortgage, and their credit score. So we can do this by setting the appropriate loan terms. DOH encourages loans to be fully amortized with regular monthly payments whenever possible. The agency may establish a range of possible interest rates and loan terms, and that can be from anywhere to 0% to market rate for amortized loans, but nothing above market rate. And if you're going to defer that loan, the loan must be 0% interest. And the loan terms can be anywhere from 1 to 30 years. Community land trust and shared equity programs may, in lieu of having an advertising loan, they can establish an equity ratio as a basis for payback for loans So upon the title change, so upon leaving the home or upon selling the home, they can split the difference of that equity. We are not allowed to charge clients origination fees. However, reasonable closing costs for title work, credit reports, home ownership counseling, all of those things can be charged to the tenant and be included in their minimum contribution. And we'll go over a little bit more of what a minimum contribution entails a little later. Late fees and legal costs are allowed. They must be determined as reasonable. There must be a basis for determining what reasonable is, and it must be defined and consistently applied. We do allow loan servicing fees for agencies that provide their own loan servicing or contract with loan servicing companies. And that amount cannot exceed the actual cost of providing this service. Loan deferrals are allowed, so agencies can defer up to 25% of the agency's portfolio. Shared equities do not count toward that deferred 25%. And CDBG programs can defer their entire portfolio, although I would caution against that. Agencies may increase the percentage of their deferred loans with DOH approval. So all of that we just discussed was relevant to all programs, but the rules that we're going to discuss right now are specific to down payment assistance programs. So you have your front-end ratios. Remember earlier we said that can go as high as 43%, but with your DPA programs, it's a little lower. So we prefer it to be 31%, but it can go as high as 35%. On a case-by-case basis, you can approve higher than 35%, but you must adequately document compensating factors. And those compensating factors include things like a credit history that show that they have an ability to pay. They have documentation or income that's not reflected in income, but directly affects their ability to pay the mortgage. That would be something like they're receiving food stamps. There is a minimal increase in the borrower's housing expense, and the borrower has a potential for increased earnings, like they're going to get a better paying job, something like that. And when determining that front end and back end ratio, you should be looking at their non-discretionary expenses, which are their fixed monthly living expenses that will impact their ability to pay their mortgage. So DOH recommends that expenses include utilities, transportation costs, medical, childcare, court order payments, taxes, stuff like that. So as an agency, you can establish your own method for determining this non-discretionary income, but it must include recurring monthly expenses to be examined. It must include the benchmarks and the standards for evaluating these monthly expenses and a description of how they will impact the underwriting of the project. This must be approved by DOH and outlined in your program guidelines. And if you are and when you are developing these policies, you want to be sure that the agency is not violating the Fair Housing Act, including any unintentional or unjustified discriminatory effects. And any non-discretionary income cannot exceed 95% of the client's gross monthly income. So if they have assets and cash reserves greater than $25,000, you want to make sure that that's spent down so that they can participate in the program. So now we're going to move forward and look at what responsible lending standards are. So once you determine that they are eligible for the loan, that the loan is a fit for them, that it's affordable but not over subsidizing, then you want to make sure that their current loan, their primary loan, is not predatory, and that it is a qualified mortgage under the Consumer Protection Financial Bureau. And that just says which type of loans are acceptable. If you want to go to that website and look at that, it's a good resource. Primary mortgages cannot exceed a 30-year term and cannot include risky features such as negative amortization, interest-only periods, and balloon payments. However, we do allow adjustable rate mortgages at the terms listed here, and we encourage that the primary mortgage escrows taxes and insurance. All loan terms and rates must be consistently applied, and loans are not forgivable unless the client can demonstrate that the net sale proceeds are not adequate to pay off the loan. So they're forgivable at that point. Clients may not receive cash back at closing. And the property must be current on all taxes, and agencies must retain proof of that in each file. Also, DOH prefers to be in second position if in any subordination line. Last but most importantly, agencies must follow the Fair Housing Act, which says that they will not discriminate against anyone through their lending practices or any decision-making processes due to race, color, religion, gender, disability, sexual preference, age, family status, or national origin. They should be explicitly stated in the agency's program guidelines and on their client information or any information that the client uses, like your applications and your disclaimers. There is a maximum loan amount for down payment assistance. Agencies must set their own maximum loan amounts according to counties, and the maximum may be as high as 10% of the area's maximum purchase price or after rehabilitation value limit. Regardless of the established maximum, the agency must analyze each client's financial resource and transaction costs and only provide as much funding as the client needs. So the maximum may be $17,000 for the area, but if you determine that the client only needs $10,000, then that's what should be provided as assistance. DOH's funding sources and assistance can be combined with other assistance. So they can get a CHAFA DPA loan or a Section 8 homeownership DPA loan from any other local program to make sure that they do receive the amount of assistance necessary to purchase the home. However, our CDBG funds only allow us to pay for half of the required down payment. So, of course, if the down payment is $20,000, the CDBG funds can only be used toward $10,000 of that payment. And after all of that, a minimum homebuyer equity is required. So we require that clients contribute up to $1,000 or 1%, whichever is greater, to the home purchase price. And you can use any of those fees mentioned earlier, like home counseling, credit reports, appraisals. Any of that can be used toward the $1,000 or the 1% as earnest money. And the total indebtedness against the property cannot exceed 100% of its value. So making sure that they are in an affordable loan that doesn't put them underwater. There is an exception for that. If they have a government-backed loan like a USDA or a VA loan, then we can approve exceeding that 100%, although I wouldn't recommend it. The agency still must show that the payment will be affordable to the client in all cases.
Hey, Evan.
Yeah.
Could Jennifer had a question.
Mm-hmm.
Could you go back to the slide that's talking about determining max loan amount?
Sure. Here?
Yep. It shows that it's 10% of the Arian's maximum purchase price or after rehab value limit. Did you have a further question, Jennifer, on that, or did you just want to see the slide? Can you talk about where the maximum purchase price comes from, Ebony?
Yes, the maximum purchase price, there's a methodology for it, and I can put that in the chats for you, but I think it's in CFR 92.254, and it'll give you the maximum purchase price for the home. So what you would do is look up the median purchase price for your county, and I might have a slide for that. The median purchase price for your county, and determine the after rehabilitation value. So for a particular county, that might be $187,000. And then what you would do is take 95% of that value for your one-bedroom unit. And I think that brings it down to about $178,000. And you would take 10% of that. Am I making sense at all? Or should I just point you to the proper reg and stop trying to explain?
Christina did post the maximum purchase price where it can be found on HUD's website.
Thank you.
And does anyone have any further questions on this before we hop back to where we were? All right, you're good to go, Ebony. Thanks.
Thank you. So I think we were going over total indebtedness and saying that you can exceed the total indebtedness of the property or 100% of its value if it's a government-backed loan. But we must make sure that it's still affordable to the client. The affordability period for home-funded programs, this is for home-funded DPA programs, is as follows. So if you put in under $15,000, the affordability period is 5 years. 15 to 40,000 is 10, and over 40 is 15 years. For CDBG and HDG funded programs, the affordability period will be for 5 years. And requirements during the affordability period, they don't have to remain low income after the acquisition is complete, but they do need to ensure that it will remain their principal residence during the affordability period, however long that would be. For single-family owner-occupied programs, so these are the policies and procedures that are germane to this particular program. There is a maximum loan amount, which is $24,999, and this covers all federal sources used to make the loan, including program income. So we can't exceed this amount without approval from DOH, and that approval must be retained in the program or in the participant's file. For emergency repairs, it's based on the value of the home. If the home is worth over $10,000, then the maximum is 50% of its value. So $55,000, but only up to $12,000 for emergency loans. And the affordability period for the single-family owner-occupied rehab program is 5 years for CDBG funded programs. If it's home, then you want to refer to that earlier chart that I mentioned. But for HDG programs, it's 5 years as well. And again, they don't need to remain low income, but they do need to remain or treat the property as their principal residence. So for CDGB funded single family owner occupied rehabilitation programs, you can go up to 120% of the value of the home. There is a waiver that is required for that, so you'll have to get approval and keep that in the file. But a lot of times that is the case for older properties or properties that require so much work to get it up to health and safety that we have to exceed the value of the home to get the proper loan to the participant. And when the home exceeds 100% of the, or when the loan exceeds 100% of the value of the home, then there are some policies that permit forgiveness of the loan after a 5-year period. And that loan can be forgiven at any time, but only one time during the affordability period. Are there any questions? Other questions?
Feel free to unmute yourself if you have a question.
Okay.
All right, I'm going to launch a quick poll just to get a pulse of from everyone to see if you're still there, but also see how helpful this training was for you. So the poll is now live. If you could please take a moment to answer, it's helpful for us to know, how well we're doing on these trainings. And while I'm letting people fill this out, just a reminder, our third, part 3 of this mini RLF mini series will be held May 12th. So if there's some things that haven't been covered that you'd like to have covered or have questions on, or an area you'd like for us to talk a little bit more, that would be helpful for us to know. We're going to have our third one be a little bit more interactive versus just talking at you, but feel free to let us know, because that's helpful and it helps us adjust these trainings to make sure that they're useful and can be referenced later. All right, I'll give about 10 more seconds for the poll. All right, did you have anything else you wanted to add, Ebony? Thank you so much for presenting today.
No, if you have any questions, I'll go ahead and if you can think of any other questions, I'll go ahead and put my email in the chats, and I'm available for anything I haven't covered or anything that you need me to go into more detail on. Thank you.
All right, well, thank you all for joining us today. You're going to have 19 minutes back to your day. And like I said, this webinar will be posted, so if someone from your agency wasn't able to join us today, we should have it on our website by the end of the week. All right, well, I hope you guys enjoy the rest of your week and your Wednesday, and I'm sure we'll all be in touch. Thanks.